Are you planning to take market share in mortgage in 2025?
Yes, we're definitely going to take market share, and we already are. Uh, and we're taking market share because service wins.
I'm Diego Sanchez, president of Housing Wire. My guest today is Jay Plum, EVP of Consumer Lending at Fifth Third Bank. Jay, it's so great to have you on the show.
It's great to be here. Thanks for inviting me.
For those in our audience that aren't familiar, could you briefly introduce yourself and Fifth Third Bank?
Sure, be happy to. So Fifth Third is headquartered in Cincinnati, which is where I'm at. I've been in banking for 35 years, and I've had a number of bank T-shirts along the way. Uh, I'm a native New Yorker, growing up in Brooklyn, but have been here in Cincinnati for those 35 years. During that time, I've managed consumer lending and mortgage for Citizens Bank, Huntington, and I've been at Fifth Third for about 4 years. I've also been on the MBA board of directors, president of the Ohio MBA, on a bunch of different advisory boards like Blend, Lending Tree, and on the affordable housing committees for Fannie and Freddie. Fifth Third is a national bank. We have about 1,100 branches, over $200 billion in assets, and we're one of the top banks in the country, although our branches stretch from Michigan to Florida. Nothing in Brooklyn yet.
Not yet, but maybe
Yeah.
soon. Recently there have been several depositories that have exited mortgage, including Ally Financial and WAFD Bank. What is Fifth Third's commitment to mortgage?
We like mortgage. We're committed to mortgage. We think our customers view it as a core product, and so do we. So we think we need to be there. We have a retail distribution channel, a direct-to-consumer model, both phone and internet, and then we have a large national correspondent business. So all told, we're in a variety of ways to get in touch with our customers and collect more customers for the bank. We do concentrate on the customer base within our footprint because we do want to sell them more stuff. That is something that banks want to do a little bit more than IMBs, and we think that that's an important role for us.
And in your mind, how do you prioritize approaching those different channels in terms of priorities in the business, staffing, resourcing?
Sure. Well, we're the 10th largest bank servicer in the country. So we've bought MSRs, and that is purely an economic play. But we do like the MSR structure, like a lot of IMBs do as well. And we think that that's a great way to generate revenue. And the immortal role of buying low, selling high seems to have applied when we bought MSRs when they were at 3 and 4% interest rates. We're enjoying that now. As far as our other channels, we do believe that professional sales matter. So we have a retail loan officer channel that services our branches and gets a portion of their business from branches, but calls on realtors because we think we can generate new to bank customers. In our correspondent channel, we have a smaller sales force, and the margins are much tighter, and we are a little bit more opportunistic there. It ebbs and flows based on a lot of different market conditions, and it certainly has gotten tougher over the past couple of years as rates increased. Our internet business, our direct business, we call all over the country, and that business seems to be an emerging one for us, and we have a little bit more work to do there. but we overall remain committed to mortgage and like its prospects.
In your retail channel, are the originators also talking to your customers about other consumer lending, or are they focused on mortgage as a product?
They're focused on mortgage. It's a tough call. We would like them to talk about a couple of other products, notably home equity, because we just want to make sure that they have a lot of arrows in their quiver for whatever a customer happens to need. But if the customer has more complex needs, they'll do a handoff. We really want them to be the mortgage expert. We want them to be that champion for a customer. And we have a thing here that we talk about quite a bit. We say it's a family, it's not a file. And we spend a lot of time very consciously working with salespeople to make sure that they treat the customer carefully, that they help them be informed, that they hold their hand in the process. It's an awful process no matter where you are. It's a lot of work, very confusing, and we want to make sure that that customer has that champion, and we think a dedicated loan officer force can do that.
Yeah, that makes sense. Now, over the past decade, mortgage origination has really been dominated by IMBs and mortgage brokers. Where do you think depositories like Fifth Third fit into that picture?
Yeah, don't count us out just yet. But we think that we're an important part of the mix for all of the mortgage industry, not just Fifth Third, but all regional banks. It's not just the super large banks that can play in mortgage. By being in the correspondent business, we continue to provide liquidity to a variety of different IMBs, and we think that that's great. I think the market is big enough that there's plenty of room for all of us, and our interests in being there are really to make sure that our customers, who are larger financial service customers than just a mortgage on average, we want to make sure that they have access to the very best products, and that's why we think we need to be in mortgage. And our role is to really help our customer directly. So we think that we can do that perhaps a little better than some of our IMB friends, but not to the exclusion of them within the overall marketplace.
And is mortgage an entry point for a customer who is new to Fifth Third, or do you almost always originate with somebody who is already a customer of Fifth Third?
Great question. And I would like to say it's always somebody new to the bank, but it's a pretty fair split between the two situations. We think that forging relationships with realtors and being in the communities is central to what a regional bank does. Every community needs a vibrant banking opportunity, not just for liquidity, but for helping with access to financial products. So there are going to be folks there who have set up deposits with us who want a mortgage, and there are going to be realtors out there who have somebody new to town, moving to town, who needs to set up all new relationships. And the mortgage is the first step to all the other products they get. We want to be the one that that customer turns to because they get such great service that they want to be with us.
So Fifth Third exited the warehouse lending business relatively recently. Can you talk about why the bank made that decision?
Sure. We weren't excited about it. And the reason why we left was because of the proposed Basel III rule change. And I think it's important to talk about that a little bit, because even though we're a bank, this Basel III proposed rule really impacted the entire mortgage industry. It made our MSRs more expensive, and it made things like warehouse a much more difficult business. Now, the rule is going to be if it's not entirely abandoned, it's changed quite dramatically, so it's not quite the burden on capital. But regional banks, just like larger banks, offer tremendous amounts of liquidity to the market. And in a fragile industry like mortgage lending, everybody has a role. And if regulation gets a little out of whack, like it did in the case of this Basel III rule, I'm not sure everybody understood the implications. And I think it's important for not just regional banks, but for IMBs to understand this Basel III rule was going to affect them, if not directly, then indirectly, by reducing liquidity for what we did with warehouse and like a couple of other banks did with warehouse, as well as with different changes in MSR liquidity. It's all part of the same situation in the industry. And that's part of what makes mortgage so interesting and such a dynamic business. But it also means that when you do come up with regulations, you got to know all the different pieces of the consequences, not just one. This was not just a regional bank problem, but that's what we interpreted as a fairly significant problem. I think it's also interesting to note that we exited warehouse, but we didn't exit anything else. And if anything, our interest in all the other parts of mortgage is still just as high as it was before the rules were proposed. But we have a responsibility to make sure that everything returns the right way. And that was looking hard under the proposed rules.
So we've got a new administration in DC, and they seem to have a different take on regulation, probably much more anti-regulation than the Biden administration. Do you think that could change the environment and maybe make warehouse lending more interesting to Fifth Third?
I think it could make everything more interesting, and it certainly is making things interesting right now. I guess the biggest thing that I would say as I look at the regulatory environment is that we're just in the early innings of taking a look at a lot of regulations that have been put in place since the financial crisis almost 20 years ago now. In that time, we've added a lot of regulation in all aspects of consumer lending and mortgage lending. And I think it's important that some balance gets restored, but I wouldn't go celebrating just yet. Frankly, I think some regulation is good. I think no matter what part of the industry you're in, an informed customer is always an important goal. Making sure that customer understands what kind of a loan they're getting into, that they understand all the implications completely and fully. It's hard to say that that's a bad thing. But some regulations might have added a little bit more cost than help. And those are the ones that I hope are targeted. But more than anything, I hope as we go down this road of looking at regulations and the institutions that regulate all the players in the industry, we do it thoughtfully. This is not the time to do things on the back of an envelope. It's important to make sure that everybody understands the implications with only one priority in mind, which is how does it impact the customer? If we can work on just taking care of the customer, focusing on reducing their costs and their burdens, everything will work out. And we'll all be happier with a little bit more balance in the system.
Switching gears a little bit, it seems like mortgage rates in particular, are going to be higher for even longer. We're starting out the year above 7%. And I don't think we'll see meaningful movements down in the next couple of months. And this is right before a crucial spring home buying season. So I think growth in 2025 in mortgage means you're taking market share. Are you planning to take market share in mortgage in 2025?
Yes. We're definitely going to take market share, and we already are. Uh, and we're taking market share because service wins. No matter what part of the industry you're in, you got to take care of the customer. And if you do, good things happen. They'll share that experience with their friends, neighbors, family, and we'll get people calling us simply because we did the right thing for the customers that were involved. But your point about high rates is correct, and it certainly has made everybody in the industry a little grumpy to expect that we're not getting a bunch of rate reductions this year quite the way we thought in August of last year. Uh, while we're higher for longer, I think the bigger concern is uh, we're higher for longer with higher home prices. So affordability is affecting parts of the customer base that you wouldn't think would be impacted. And we need to be careful about that. So whether it's a down payment assistance program or adjusted fees, and hopefully maybe it's regulatory changes and GSE changes that allow us to pass savings on to customers, we need to make sure that affordability is still reasonable for all aspects of the customer base. And the way the rates have gone, particularly with appreciation in some markets, uh, I think we have a lot of people who are concerned that they can afford a home. They still can. It's just they need to get a sharper pencil in calculating it out. It's still a great way to build wealth, and we want to be right there with customers, helping them understand that equation.
Yeah, your point on affordability is a really good one. We're actually, our next research paper at Housing Wire is going to be focused on that topic, and we'll publish that probably in mid-March. Are you at Fifth Third doing things to help with affordability? You mentioned down payment assistant. There are other programs that can help put people into their first home. What's Fifth Third doing on that topic?
Well, we're trying to be as proactive as we can on affordability, and there are a couple of things that stand out. First of all, is making sure that we're out in our communities talking about the information a customer would need to consider a loan. A lot of customers see home prices or hear about the rates and then just sit on the sidelines deciding to pay rent because they think it's overwhelming. They might not know of the different programs that are available. Some of the things that we do have a down payment assistance program. We think that that is a critical part of tackling affordability because the down payment can be brutal depending on where you are. Uh, it just is 20% down payment in certain parts of rural Ohio is much different than 20% down in certain parts of Tampa. But wherever you're at, 20% is a big damn number. And helping customers get there is one key thing. In Columbus, Ohio, and I'll talk a little bit about the Convergence initiative from MBA that I'm chairperson of now. Getting different groups together within the city to talk about how do we provide home buyer education, how do we let customers know about available down payment programs, and how do we give them the confidence they need that they can actually go and buy a home is important. But on the down payment side, we worked with the Homeownership Council of America, and we've helped over 500 families get into a home that they didn't think they could have because of a special purpose credit program, one feature of which was down payment. I think special purpose credit programs, which popped up all over the place last year, are important because they do provide ways that in a controlled manner can offer relaxed credit guidelines as well as down payment assistance. And Fifth Third has set up their own to do just that. Now, it's not offered in every community and it's not offered to every customer, but it's offered to a heck of a lot. And whether it's our program or somebody else's, special purpose credit programs are going to be a key feature for helping people get in homes in the future. We were lucky enough to be one of the pilots for Fannie and Freddie in their programs, and we helped over 600 families just in the last year with that program, and that worked out great. Those are families who wouldn't have their own home. So we take great pride in that, and we'll keep looking for ways to do things. Not everything will work, but the key is to try, and the key is to keep listening to the community's needs to figure out what we can do to help.
I love that. That's a real impact. Hundreds and hundreds of families for sure.
It's pretty neat.
So Fifth Third has geographic strength in the Midwest, and then it sounds like down into the Southeast as well. Does your mortgage team originate beyond that geographic footprint, or do you stay within the confines of where Fifth Third has branches?
Our immediate sales force of loan officers in the field is in that area, but I do have a few that I can get you a deal in Brooklyn if you really are asking that. So that's not a problem. But beyond that, yes, our sales force is best served physically in our territory, helping out our branches and making sure that we're the presence in the communities that we operate in. Our call center, our correspondent business, our internet business is more national in scope, and will service customers however they get to us. I think that's going to be much more significant in the future, but I've always thought we need to be where the customer is, servicing them in the way they want to be serviced, with as much or as few interactions as they want, making sure that they have access to all the data that they need. And as long as we do that, while I'm excited about our salespeople in the field, I am also excited about just getting a new customer wherever they might be.
So let's talk products. What's the product suite for mortgages at Fifth Third?
It's great. All right, I'll go into a little bit more detail. We have a little bit of everything, and it speaks to the idea of we think customers need options. And it's probably one of the things that differentiates depository institutions from IMBs. I have a portfolio. I can use it. And for certain customers, I use it. So my lending authority goes up to $15 million, and I can do a lot of wealth loans. I don't do very many, but we can do those and put those in our book. But I also can do some unique things on affordable housing that don't necessarily conform to Fannie Freddie guidelines, like my special purpose credit programs. And I can also portfolio those loans and offer those communities more diversity in the products that are available. Just like everybody in mortgage, we love what the GSEs offer, but I think making sure that we have a multitude of products, which is occasionally very annoying. It is a pain in the neck to maintain all the rigor around 250 products. But I think being able to deliver a customer the maximum flexibility with a variety of options that can be customized to them is worth the complexity and worth the hassles, because it's always and always has to be about the customer and their needs.
Absolutely. But I imagine there's an education challenge, not only with the customer, but with your sales force with that many products. How do you keep them educated about this very large menu of options?
Well, we like to view them as real estate professionals. And our expectation is that this is what they do. They need to know how to put somebody on a loan, and that's in their best interest to know our product set, but sometimes they don't know all of it, as you indicate. And then we have to have systems that support their effort. Going back to the idea of is Fifth Third committed to mortgage, we've committed to upgrading our origination systems and upgrading our servicing systems, pretty significant investments. And all of them will be designed to not just help the customer with digital servicing and digital tools, but also help the colleagues with access to resources to know more about the products we offer, the processes we have, and to make those processes easier. I mean, it doesn't substitute for a great conversation with a great loan officer who can really listen and tell you, hey, these 4 products sound like they would be the best for you. But we think that we can help that loan officer figure out, is it really 4 products? Was it 3? Was it 5? And give them the tools they need to make sure that that's a rich conversation.
You mentioned being opportunistic about MSRs. And I wonder, are you servicing those folks in-house, or do you have a sub-servicer that handles the servicing relationship?
We really respect sub-servicers, but we do it all. And we like to keep servicing, and we enjoy having a big book, not just for the opportunity to service their mortgage, but also to tell them about other products that Fifth Third offers. In my own little consumer lending world, we have cars, RVs, boats. We also are one of the largest solar lenders in the country. And between all of those products, let alone home equity, we have a lot to offer the customers that we service on the lending side. But we have a lot of pretty attractive depository products. We think being the servicer makes it a little bit easier for us to deliver those conversations and deliver those products and strengthen our relationship. And maybe through that strengthened relationship, change the nature of the economics on the underlying MSR a little bit as well.
Yeah, that's really interesting. I mean, the recapture opportunities are not just in originating or refinancing, but you've got all these other consumer lending products that you can recapture folks with.
Servicing is an invitation, and being able to prove to them that they're going to get great service on the mortgage side gives us the opportunity to talk to them about other stuff. And then when they have a home equity, it's likely that they're going to also call us when they finally want to refinance that first mortgage or change the nature of their other debts into a cash out refi. And someday there will be cash out refis again. There are a few now, but there'll be more later. And I think we're pretty well positioned as long as we take care of that customer through the cycle and through the process and make sure that they know that they matter. We're not so big that we're not concerned about each customer in the portfolio. So everybody matters.
So what is an ideal percentage for you in terms of the mortgages you originate moving into your portfolio?
That's a great question, and one that changes quite a bit. And it really is tied to interest rates. And it's also tied to the regulatory environment. This Basel III thing was going to change that percentage dramatically because the cost of those loans was going to skyrocket. That added capital could have meant that we would have only done affordable housing loans for our book and looked to sell just about everything. Fortunately, with the changes, we're a little bit more reasonable. I could give you a percentage, but it honestly changes based on rates and based on what the market demands. But if we had our druthers, we'd be selling a majority of our loans every month. That's not to say we don't want to use our portfolio. It's just that the economics are better to sell them.
Jay, this has been a really fascinating conversation. Thank you so much for joining me today on Powerhouse.
It was great to join you. I really had a good time. And let me know when you need that refi. I'll get somebody out there.
Absolutely. Thanks so much.
All right. Take care.